Welcome to Biz Ed Made Simple. Now, did you know that when you go and give all of your life savings to a bank, what they don't do is put it in a big safe. What they actually do is go off and invest it and gamble it and get profits off it. What? Yeah, that means that they are actually putting your money at a little bit of risk, which begs an important question. Why do we therefore all give our money to banks? Why don't we just lock it up and keep it under the bed or in a safe in our house? Here's another question for you. Did you realize that banks are not owned by the government? They are not a charity, and they are most certainly not your friends. So there's another question then. Why is it that banks lend people, you, me, and everyone, money then? If they're not your friend, they're not working for the government, why are they lending money? Well, the answer to both of those questions is interest rates. Interest rates, it's really important you understand them. So, the definition of interest rate, an interest rate is the price an entity pays for borrowing money or the fee they charge for lending it expressed as a percentage. Now, once more, that definition is confusing, so let's break it down into how it really matters and what it means for you and me. Well, the way it works. So interest rates are set by an organisation. In the UK, it's the central bank, which is owned by the British government. So it's pretty much the government. Now, let's imagine the central bank comes out and they say, from now on, interest rates will be 10%. Now, that announcement has two effects, according to the definition. It does have two effects. The first thing is it changes the rate of borrowing. Now, that's going to make some people very, very sad. So what does that rate mean, 10%? Well, if we've got this person here and he's borrowing 1,000 euros and he intends to borrow it for 1 year, at the end of the year, he'll have to pay back 1,000 plus 10%. And that 10% is quite high. So he will have to pay back an extra 100 euros to the bank. They'll have made 100 euros off him. But it affects two things. That 10% also affects the rate of saving. Now, this person is going to be very excited because let's say she's got 1,000 euros in a saving account in the bank. She can do absolutely nothing for that year. She can sit on her bottom, and at the end of it, her 1,000 euros will have added on the interest rate of 10%. So she will have made 10%, 100 euros for doing absolutely nothing. When you change those interest rates, if we lift it up to 20%, it's going to have an effect on both of those people. Okay, the only thing to add to that is that I'm not quite telling the whole truth, because that 10% we call the base rate. That's the standard recommendation. But of course, banks want to play with it. They are private and they want to make money. So they adjust those rates. So the rate of borrowing might start at 10%, but it might push up with financial economies of scale, which you can look at in another video. Equally with the savings, they might promise 10%. They should give 10%, but they might give less of that in order to make more money for themselves and keep their money. Okay, that's interest rates. Next questions, though, that we need to be looking at in other videos. Why do central banks change their interest rates? What are they doing it for? Good question to have a look at. How do business respond to these changes in interest rates? And how do interest rates link to inflation? If you want to find the answer to those questions, like and subscribe, check the video libraries. I hope it helps.